Nigeria's economic potential is constrained by many structural issues, including inadequate infrastructure, tariff and non-tariff barriers to trade, obstacles to investments, lack of confidence in currency valuation, limited foreign exchange capacity, and worsening insecurity, which is posing a threat to the growth of foreign direct investments into the country. However, the continuous moderation in inflationary trend for 3 consecutive months, coupled with the GDP growth in the first quarter of the year, as well as an improvement in the Manufacturing Purchasing Managers Index, shows an indication of gradual recovery of output growth in the economy. Now, with the present state of the Nigerian economy faced with myriads of challenges such as increasing unemployment, pervasive insecurity, dwindling investments in critical sectors, economic experts are of the view that government must, as a matter of urgency, adopt a different approach in finding workable measures and concerted actions towards achieving economic growth and national security. Well, to discuss this more, this first Monday of the month and other burning economic issues, of course, I have joining me in the Lagos studio. He's live. Yes, he's the Chief Investment Officer of Afrinvest Management Limited, Mr. Robert Omotunde. Good afternoon, Mr. Omotunde. It's good to see you.
Thank you. It's my pleasure to be here.
Yeah, preparing for this discussion, a lot ran in my mind. A lot has been running through my mind over the weekend because we have a lot of issues on the plate to grapple, a lot to really talk about. But first, with what we face at the moment and this third wave, I want us to start on that note. It's scary to me.
Absolutely.
Because the numbers are actually going up. And we've seen what's happening even in the global space. What do you think? Are we not going to be having some reprojections? World Bank is still saying Nigeria will grow at about 2-point-something%. I think the federal government still believes we will grow at this rate. Though there might not be any lockdown. Or there might be if we need. What do you think? What effect do you think this will have on the entire space?
I mean, talking about the third wave, it's particularly not as damning as we experienced during the first wave, I must say. Remember, we had the first wave and then the whole economies went all down, and then we developed a vaccine, and people got vaccinated, even though it hasn't been so much. It's not widespread yet in terms of vaccination, but at least that is some baby steps towards full recovery of the economy. And then we've seen the much of improvements that has brought. Oil prices recovered, and still very strong at the moment. Most economies bounced back, as against what we witnessed in 2020. 2021 has been quite good for some economies. Even markets, seem to have, sort of recovered from the gloom or the doom, if I would say, of the 2020 episode, given the, outbreak of the coronavirus pandemic. Of course, the third wave is something to worry about, especially now that it seems the vaccines developed may not be 100% potent to tackle, this so-called third wave, but it's still a positive, knowing that once you are vaccinated, your system is still able to, know that even though this is a mutation, to some extent you still get protected by the virtue of that vaccination. But that's on a global scale, and then looking at the developments and all of the issues coming around, especially with growth projections, like you earlier highlighted, we do not also think that there will be any episode of lockdown. Rather, what governments will now try to do is to continue to persuade citizens to behave responsibly, get yourself protected, wear masks if you have to, social distance when you have to. And then corporates and organizations are still maintaining, the work from home policy. I mean, especially for, those who are dealing, the financial institutions, basically, those who have issues at the manufacturing, and of course, maybe people in your industry who just have to report in the studio. But by and large, if you look at what is going on back home and how government has been responsive to tackling these issues, I mean, we must give it to the government in terms of maybe we didn't have a choice. Economies world over had to rise to the occasion of the challenges that COVID-19 pandemic brought upon all of us. And then we had to now, set up a special task force, which has been very active. Even in this third wave, they've been the ones shouting, putting out all sort of jingles just to make people know that these things are real, and then we have to behave responsibly. And in terms of the economy, the responses has been, quite good as well. We know of all the different interventions that have been coming from the central banks and go, in terms of, different supports that we've gotten for different industries.
And all
Although there are other macroeconomic headwinds that we have to grapple with, one of which you mentioned, exchange rates, the fact that domestic prices are rising, growth numbers are not as strong, even though we may likely see some, base effect recovery. I call it base effect because you're going to see some improvement. I mean, from the first quarter number we've seen improvements that are largely, well, maybe the first quarter number cannot largely be attributed to a base factor, because Q1 2020 GDP was quite strong. But from Q2, you begin to see some base effect, should I say base effect improvement, which I'll call basically mathematical, because from what we have drawn and our numbers, if we record any growth level below 6%, or say between 5 and 6%, you will recall that it's just a mathematical effect that we've seen. What will really be desirable is for us to see growth above the 6% levels, in this Q2. Because if just working the number and using the same data you have as a Q4 2020, relative to what we are expecting for Q2 2021, you just find out that you will grow at least almost 6%. That's why we say it is a base effect. So I don't expect that GDP growth for Q2, for example, will be lower than 6%, worst case maybe 5%. That way we will have improved, but the improvement would have not been real, because it will have been based on the significant dip. We saw a significant dip in Q2 2020 when the GDP was down by I think around 6%. So we should expect that same improvement by this quarter two. But whether we will begin to get back to that path of growth that we used to have, sustained 7% levels of growth that we used to have, it's become more like a cliche now. Between 2004 and 2014, strong level of growth, whether we will have that sustained is, what we are not so sure about. But the projections are quite realistic. When you look at World Bank, IMF, even projections from, local economists as well, they look realistic, given that it's a recovery from the dip that we suffer in 2020. Not necessarily because anything, significant would have been done. Because, for example, what we saw in Q1, was sort of a decline on a quarter-on-quarter basis. If you look at Q4 GDP relative to Q1 2021, it was a decline on a quarter-on-quarter. But year-on-year, there was some sort of improvement. And as a Q1 2020, the full effect of COVID-19 pandemic hadn't, hit us. It was not until Q2 that we saw it. That's why we expect that the growth number for Q2 will be quite strong, but again, on a base effect factor.
It's a very good way to start this discussion, touching on all of the facets and, across the economy. Now, policy issues pop up here. When you have a problem like this, you need to activate all that you can do, within your kitty to actually address it. Now, the central bank has come up with a new one, which is something, we must talk about.
Absolutely.
Not giving BDCs dollars to do their business. We've seen the effect one way or the other from last week. Some are saying gradually the naira is trying to firm up back and all of that. In your submission, what do you think, in your opinion, about this move by the Apex Bank, and what does it really mean for the market? Someone told me that there's no change. They're just changing the source of that same money to the banks.
Absolutely.
And how well can the banks actualize this dream of addressing this disparity?
Okay, I think it's always good for us to dissect issues from the intention of the policymakers. And I think the intention of the central bank this time around has been consistent with what their intention has always been, which is that you want to block the loopholes. You want to ensure that monies that are released on the basis of foreign exchange allocations that are valid. In the books of central bank, there are some items that are valid for FX allocation. There are some that are not valid. The 41 items, which has now become 42, and I think,
or 43?
Yeah, we're going to have 43 items now.
We have wheat almost joining that. Wheat is there now.
Of course,
not totally.
Yeah, it's difficult to put wheat there, given that there is no local capacity really for production of wheat. I mean, people will not have to eat bread anymore.
Yes,
it now means that you resort to cassava bread, or what you call it.
Yam.
But what I'm trying to say in essence is that the intention of the central bank is quite genuine, which is that there is scarce, resources, and we have to allocate them in a prudent manner. And without also denying the basic things that people need, FX for: your personal travel allowance, your business travel allowance, your medical trips, education. Those are valid items that the central bank still recognizes, as sources of allocation. However, what they are trying to curb right now is the sort of inefficiency that may come if you're using the BDCs, that maybe the central bank does not have direct control over their activities. So perhaps in their wisdom, they've been able to find out that some of those FX still get, allocated to the market, or the segment of the market that is not approved by the central bank. And I think that is what they are trying to curb at this time. But we've been at this phase before. If you cast your mind back, what is happening now is similar to what happened in 2016, when a similar pronouncement was made. But the BDC, institution is quite strong.
It is.
I know they
come out with a press release and say they still continue to sell forex.
Exactly. I know they will find a way to lobby the central bank at some point. But the implication for this is, like you said, central bank has not told them not to sell FX.
Yeah.
If they are able to source it from other means or other ways. Yeah. So the only thing that has happened now is central bank will not sell to them. So, but individuals or institutions who have foreign exchange flows and would prefer to transact businesses with them can still go ahead to do that. The implication is that they might be doing it at a much higher rate, which is the effect that we have seen since last week when that news was announced. But whether it will stabilize, I think it will stabilize at some point, maybe the current level, except we have this sustained for a prolonged period of time. Because mind you, the central bank is also challenged in terms of accretion to the reserves. I mean, you mentioned it, you're seeing it.
I was going there too, your assessment with regards to this.
You see the reserves growing, but fundamentally, we know that there is a problem. The problem is that we're not seeing as much should I say, accretion to the reserves as we would expect, given that oil prices are strong right now. Maybe because of subsidy payment, which of course is an issue that we have refused to discuss, even though it's something major that we have to discuss. Central bank loses some FX, in that regard. And then you're seeing a situation where data on capital importation, which was also released by the MBS, recently suggested that, that we are not even getting the much of FPIs that used to be a boost. Remember, in 2016, when we had this similar episode, by 2017, when government, the central bank, created the I&E FX window, we saw a bit of flexibility and foreign investor confidence, was sort of, reboosted. And then they came into the market, and then we saw flows. Capital importation jumped significantly, to tens of billions of dollars. But right now we are seeing, more like the reverse of what happened at that time. And for most foreign investors, what they are looking for is what's the investment climate is like in Nigeria. Do we have stability? Do we have consistency in policy? Because for them, that is very critical. You can't bring your money in today and then policy has changed tomorrow. So again, they are very, very mindful of that. So, and that is why most of the things they look out for is all of those parameters. That's why we are still seeing FPI hasn't improved, should I say, since coronavirus pandemic struck. Maybe because most of these foreign portfolio investors are also comfortable, playing in a much safer market at this time. Talk less of the foreign direct investment, which we have continually suffered. Even when there was recovery in 2017 of FPI, FDI did not follow through because, again, there are structural issues within the economy that needs to be addressed if we are going to address, that long, or should I say, age-long problem, of FDI, shortages into our system. But by and large, I think the system always has a way of, being resiliently fighting some of these issues that are contending with it.
Fighting these issues, there are much debt.
Absolutely.
Is another one that is on the large side. Like the report today from Debt Management Office shows that just to World Bank and African Development Bank, we're doing about $14.25 billion. That's from $7.14 billion before now. Our debt profile seems to be worrisome, and what our debt servicing, it is just worrisome when we look at all of these figures. Now, how do we grow with this kind of burden? I'm worried. How do we spell it out? As an economist, maybe you want to explain more to us.
Well, again, so, the position of economics or economists has always been that borrowing is not a problem.
Yeah.
But what do we spend our borrowings on? That is what is most important. Because you must be able to, deploy your borrowed funds to sectors that will, more like reproduce revenues that you can use to then repay the debts, right? So if we go and analyze the issues on a detailed basis, the tendency is that you will find part of our borrowings going into recurrent expenditure. We've analyzed that before. Yeah. And the issue is, like you mentioned, debt service, right? Because right now, you will argue that our debt to GDP, is still quite manageable. We are not as there as, countries like Ghana, where their debt to GDP is almost, hitting the roof. I think theirs is close to 70 or 80%. For us, our debt to GDP ratio is still within a manageable size. Of course, definitely below, the 50% levels, right? And if you look at that, you could want to argue that, yes, we still have a level that is sustainable. Yeah. But when you now compare that to our debt service to revenue, in which case, when you look at 2020 budget and the performance, debt service to revenue almost hits about, I think, 70%. And as we speak, given the weaknesses that we're seeing in terms of oil accretion, we may be moving dangerously towards, an 80 to 90% debt service to revenue levels. Now, what I would tell you is that at some point, your more borrowings that you're taking, you're just using them to fund recurrent expenditure, and that's a dangerous place to be. So now the issue would then be, how do we begin to recalibrate, and address these issues frontally? There is no how we can take the blame away from, the managers of the economy on the fiscal side, I must say, because again, the debt burden is a direct reflection of our expenditure or spending pattern. You will recall that when this government was just elected in 2015, one of the ideas they came up with is zero-based budgeting. Yes. Which is that you're supposed to build ground up. But I think they did that for the first year, but they haven't done that after then. Now, what we then see on a year-on-year basis is that from the level you spent last year, you then put some percentages on top of it, and that becomes your budget the next year. And that's not helping us because, again, they're not even able to drill down in detail what those monies are. I have a view that the sort of recurrent expenditure burden we carry now shouldn't be that much, especially knowing that we're a poor country. There is this rhetoric that I've sold for so long that Nigeria is oil rich and things like that. We are not.
We are not.
You understand? So if we begin to act as a poor country, there are some spending that we shouldn't be doing. You understand? But it has to come from the highest level of government where, we are ready to, because doing this means that you may even be politically unpopular, because you may decide that you want to cut down the number of ministries that you have, departments. It might mean that some people will lose government jobs. But if those things...
What is happening in Kaduna State? Sorry to interject you.
Yeah, it might mean that people will lose...
spending more than 90% or how many percent of his paying salaries?
Just think about that. So you may have to cut down the size of government for the greater good. For instance, if you cut down the size of government and some people lose government jobs, but you are able to, play in certain sectors of the economy that allows people then to regain that same job they have lost in the private sector, you'll find out that the nil effect on the economy is positive, than say, oh, we don't want to bite the bullet. There are certain times in the life of an economy when you have to bite the bullet, So, it comes with a lot of will. It comes with a lot of sincerity. How many, of the economic managers are sincere? It has to come from from a sincere point of view, because biting the bullet in Nigeria takes a lot. You know, it might even make you lose your job. The guy that is pushing forward the policy to bite the bullet might lose his job in the process. So, but how many people are willing to, you know, pay that kind of sacrifice? So it's a gamut of issues, but we need to start addressing them if we want to, you know, leave a long-lasting, you know, positive impact for the next generation.
Before we wrap this up, because like you said, a lot of challenges as we say. We're talking about the fiscal side, monetary side, and all of the efforts we see from both sides. But with all of these challenges, unemployment is at 33.3%. We have issues of subsidy you talked about. We're trying to shift away from that now. We don't know what the position is. We know Labour and NNPC been talking about that. We spend billions of naira to subsidize for PMS. And also, VP just talk about it recently about also electricity subsidy. The government might also pull. So what are we looking at moving on in the year? Let's do an overview of what Nigerian or a minimum wage worker that earns 40,000. What kind of life are we going to live in this year?
You know, I think I've said it before. We envy the industrialized economies that are successful, top of the list, the US economy, the UK economies, you know, sometimes the Chinese economy, but we are not sometimes ready to do some of the, you know, tough things that they do, you know, to get the kind of success that they are getting. See, if we want things to work better in the system, we have to get to the point where we begin to embrace market principles to driving all aspects of our economic life. And when I say market principles, you know, you can apply it in different problems that we are facing right now. Call it FX. If you embrace market principles, we can solve the problem. Call it subsidy. If we embrace market principles, whether in the oil sector or in the, you know, electricity sector, we can solve the problem. Now, countries that have successfully, you know, increased the sort of generating capacity that they have, you know, Ghana, you talk about South Africa, you know, within our African, you know, frontier that we want to look at, they have had to, at some point, go the market way. And we are seeing it before our very high working, even in our country, Nigeria, where we talk about subsidy, right? We see different clusters of buyers who are willing to pay the reflective market price, and they are getting power. And then we say, oh, there's no power. You know, for instance, if you ask me, it's not my experience, you know, because power is quite stable where I stay.
Yeah, it is.
Because you know, the clusters of farmers, users decided to pay the premium that is necessary to achieve that. Now, if government use that as a test, something happening even within our system, then we can begin to have an inkling into how we can solve the power problem. You know, subsidy doesn't do any good to anyone, honestly. You know, sometimes we think, you know, would people rather get subsidy and then they can't get jobs, right? Or would people rather get subsidy and they drive on bad roads? So we have to address the issue of subsidy in a different way. We can't just give a blanket subsidy where the rich and the poor enjoy. For instance, if you don't live in an area where, you know, there is an agreement between the distribution company, so it means that the rich and the poor are paying the same thing for, you know, electricity. It's cheating the poor. That's what we're saying. So if we can begin to address these issues from the point of view of market principles, then we can have, you know, some headway in terms of finding a solution. But for as long as we want to, you know, keep playing the, how do I say it now? You know, government wants to look, you know, good to the people. And then people, most times, they don't know what is even good for them. So it is the job of government to educate them that it is actually more beneficial for the economy and the individuals actually to do away with subsidy. I mean, we've analyzed PMS subsidy, that the rich benefit more than the poor. The poor don't have cars. They probably don't have a generator. And then you are subsidizing the lifestyle of a minister, the CEO of a company, the chairman of a local government, you know, or someone like you, for example,
like you,
who Who doesn't need a subsidy, honestly? So if we begin to address that issue from that perspective, then we know that it's not a good thing for us. And government can free up resources to actually tackle critical areas of the economy. And then we're moving forward.
All right, baby.
It's the way to go, right?
Honestly, it's always nice having you on the show. The whole of the show won't be enough for us to talk about the challenges we have in this country, but this much time can take. Chief Investment Officer, Afrinvest Limited, Mr. Robert Omotunde, thank you very much for starting this week with us. We really appreciate this.
Thank you.
Thank you so much for your